Hey Big Bulls, welcome to another episode of Bullseye. Today we talk about DLF and India's realty story, a setback for Protean eGov and the Leela Hotels IPO. So let's start. DLF's pretty much the big boss in India's real estate game. In fact, it's the largest player when it comes to market capitalization. And judging by the buzz around its Q4 results for FY25, it looks like the company has seriously impressed investors and even analysts. The realty stock shot up 12% in the last 5 sessions as compared to just a percent rise in benchmark Nifty. And why not? The company just posted a 39% profit jump for the January-March quarter and hit its highest ever sales in FY25, all thanks to the super luxury housing boom. But wait, there's more. DLF's aiming for 22,000 crore in sales for FY26. They are banking on their killer pipeline of new projects in hot markets such as Delhi and Mumbai. This ambitious target reflects the shifting dynamics of the industry, especially as India's real estate sector, which faced a rough patch from 2012 to 2020 due to regulatory hurdles and consolidation, is now on the rebound. Since March 2021, things have started to turn around for the industry. Prices are rising, sales are picking up, and the real action is happening in the premium and ultra-luxury segments driven by the growing demand for high-end homes thanks to urbanization and fatter paychecks. People are craving for more space, better amenities, and a lifestyle upgrade. And developers have been more than happy to cash in on this trend, with DLF leading the charge. Global brokerage Jefferies even highlighted DLF's solid cash flow, which has boosted its cash reserves as well, which is definitely a major plus for the company. Even other big brokerage names like Morgan Stanley and Nomura are all bullish about DLF's pipeline and its move to try to make the most of the luxury housing boom wave, finding its valuation attractive relative to its peers. Now, as the sector continues its post-pandemic recovery, will DLF be able to maintain its position at the top? That will be something to keep an eye on. 10-digit PAN card has pretty much become an unofficial ID card in India. And since 2003, Protean eGov has been in charge of handling PAN applications for the income tax department. They have basically been the backbone behind getting PAN cards into our hands. They even rebranded from NSDL e-governance infrastructure in 2021 to reflect their growing focus on digital systems. But suddenly over this weekend, things started to look uncertain for the company. So what exactly happened? Well, the company was notified by the tax department that it has not been shortlisted for the next round of the PAN 2.0 RFP selection process. And as you would expect, the news did not exactly sit well with the investors. The stock took a nosedive, crashing 27% in just 2 days. All because Protean missed the chance to be part of the tax department's big plan to overhaul the tax system. Their bid for the PAN 2.0 contract was turned down, which is a government project aimed at adding new features to the current PAN cards. Brokerage equities even said in a note that the news is bad for the company since PAN services make up about almost 50% of its revenue, and the segment, which has been funding new projects, is now at risk. But on the flip side, Anand Rathi said that the move is bad for sentiment in the short term, but it does not see much financial impact since core PAN operations are unaffected. And this view was later followed by the crucial clarification from the company. The company explained that the PAN 2.0 RFP process focuses on designing, developing, and managing the core tech systems for the income tax department, an area that Protean was actually not overseeing. Also, the company's current mandate to operate in the PAN application and distribution remains intact. This mainly involves gathering applicant info, whether it's for new PAN cards or updates, and securely sending that data to the department. Now, this news gave minor relief to investors with the stock closing slightly in the green on Wednesday. The story of Leela began in the 1980s, and today the group is basically one of the go-to names for all things luxury, whether it's hotels, resorts, or real estate development. Now its operator Shaw's is taking the journey to Dalal Street. The IPO is dropping next week from May 26 to 28, and the company has kept its price band in the range of 413 to 435 per share. It plans to raise around 3,500 crore. How? Well, 2,500 crore from fresh share issues and another 1,000 crore through an offer for sale from its promoter Brookfield. Now, what's the game plan for all that cash? Well, about 2,300 crore will go towards wiping out or repaying debts at both the parent level and its major subsidiaries. It's a smart move considering the company and its subsidiaries have a total of over 3,900 crore in outstanding loans as of March 25. In case you're wondering, Leela is taking on some serious competition from the likes of the Indian Hotels Company, Charlotte Hotels, Juniper Hotels, and even ITC Hotels. And here's how it compares with its listed peers in terms of some key ratios. And if you look at the numbers, the company did bounce back in FY25 by reporting a profit of 49 crore as compared to a 2 crore loss in FY24. Also, Leela's RevPAR or revenue per available room, which is a key metric that shows how much money a hotel makes from its available rooms, grew from 1.2 times in FY19 to 1.4 times in FY25. And it's got some muscles as well. Leela positions itself as one of India's largest luxury hospitality brands in terms of room count, with around 3,500 rooms spread across 13 properties, including the Leela Palace, the Leela Hotels, and the Leela Resorts. They're certainly a major player in the industry. Well, that's it for today. We will see you next week with another cracking episode of Bullseye. But before you go, do not forget to subscribe if you haven't already and hit that bell icon so that you know when the next episode drops in. We'll see you next week.